Welcome to our Moments with Investments Gurus webinar. Before we jump into the heart of the program, let's take care of a few housekeeping items. We applied for Continuous Professional Development or CPD points for this webinar. To ensure you receive these points, please make sure you watch the full session and add your ID number to the CPD section. You can watch this event on this platform at any time until the end of November and still be eligible for your CPD points. The CPD certificate will be mailed to you during December 2023. We encourage you to actively participate in the discussions. If you have any questions throughout the presentations, please feel free to ask by using the Q&A section, which you'll find on the right of your screen. Our speakers will be on hand to address your questions either live or during the event, or they will get back to you after the event. You can find more information about our speakers under the Speaker tab located on the top menu bar, or if you scroll down. Additionally, if you'd like to download the presentations being shared today, look for the PDF download link. I do hope that you enjoy the session and find it valuable. First up is Theo Blanche, our Executive Head of Investment Management, who will do a brief introduction for us. Welcome, Theo. The stage is yours.
Thank you, Mike. Good day, everyone. Welcome to the next installment of our Moments with our Investment Gurus webinar. We realize that there is no shortage of options for you when it comes to online webinars, and we appreciate your attendance today and your support for our business. Central banks around the world have been hiking interest rates aggressively over the last 18 months in an attempt to slow rampant inflation. While this approach has certainly yielded results in stemming the increase, the moderation of inflation has been slower than anticipated. The recent conflict in the Middle East and the resultant spike in the oil price has highlighted uncertainty around whether we've seen the peak and how long it will take for inflation to return to target levels. All of this results in the expectation that interest rates will remain higher for longer and that investors will have to adapt to this environment. This, of course, creates opportunities in various fixed income asset classes and lead us into our agenda for today. Our economist, Sanisha Pakrasamy, will start us off this morning with a general overview of the current macroeconomic environment, focusing specifically on the inflation and interest outlook over the coming months. Momentum Investments recently acquired Crown Agent Investment Management, a UK-based firm that specializes on the management of central bank reserves. CEO Robert Grava joins Mike Atsitz, Chief Investment Officer of Momentum Investments, for a discussion on inflation and interest rates through a global lens. Cash is certainly king at the moment, and following Mike and Roberts, Sisanda Gala, Senior Portfolio Manager responsible for the Momentum Money Market and Enhanced Yield Funds, gives us her perspective on the opportunity set for the funds she manages. Following Sisanda, Ian Scott, Head of Fixed Income at Momentum Investments, will share his view on the current environment and more specifically what this means for the flexible income fund he manages. Lastly, Stanley Bishu, Portfolio Manager in the Systematic Strategies team, will share with us what this high interest rate environment means for equity returns and what investors can expect in future. I hope you'll find the insights from today's session valuable, and as always, please feel free to reach out to us afterwards if you'd like to engage further on any of the topics discussed or if you have any questions. Thank you.
Thanks for setting the scene, Theo. Next is our economist, Sanisha Pakrasamy, who will outline the root causes of higher than expected inflation, what is underpinning the underlying inflationary pressures, and how this shapes the higher for longer interest rates narrative. Thank you for joining us today, Sanisha. Please take it away.
Thank you, Mike. Hello, everyone, and thank you for joining us. Inflation is as violent as a mugger, as frightening as an armed robber, and as deadly as a hitman. These words of Ronald Reagan, who spent the first years of his United States presidency battling the problem of inflation may appear excessive, but it is crucial to contextualize the severity of the inflation problem during his era. In 1980, the year he assumed office, US inflation reached a peak of 15%. The narrative of inflation stretches back to the inception of money itself, but when the genie escapes the bottle, its repercussions on an economy are profound. Unrestrained price escalations can erode buying power, grind away at corporate competitiveness, and widen the gap between the rich and poor. Since the early 80s, most of the world's mature economies have kept the inflation genie safely locked away. However, in the aftermath of the COVID-19 health scare and the war in Ukraine, fears over inflation cropped up yet again. This time, the inflation genie escaped the bottle for a number of reasons. The most commonly cited factors driving the recent upswing in inflation are high food and energy costs. These prices soared after Russia's invasion of Ukraine, driven by worries that Western sanctions might impede the flow of Russian hydrocarbons to the global market, while droughts, higher input costs, and tangled global supply chains drove up food prices. The surging cost of staples squeezed family budgets worldwide, even leading to social unrest in some countries. Food and energy costs have nevertheless retraced significantly in the first 3 quarters of this year, while global supply chains are running far smoother. Yet, despite a retreat in inflation concerns from their peak, global worries about price pressures persist as inflation continues to exceed targets in most economies worldwide. This is hardly surprising when one considers renowned economist Milton Friedman's theory that changes in monetary policy affect the economy with long and variable lags. Authorities responded to the dampening economic effects of pandemic lockdowns with substantial interest rate cuts and asset purchases, alongside ample fiscal stimulus to support households and businesses. Assuming a lag of between 12 and 24 months, these monetary policy changes would have had more powerful effects on raising inflation during 2022 and 2023. Factors driving the sustained rise in prices have varied across economies. In Europe, prices have stayed elevated due to previous significant price jumps, especially in the energy sector, given the region's dependence on Russian energy imports. These price shocks have had a cascading effect on connected industries by impacting the cost of supply chain inputs and consequently prompting demands from workers striving for wage growth to match the rise in their living costs. Meanwhile, in the United States, the tightness in the labor market has been a particularly strong driver of second-round inflation. Heightened demand for labor-intensive services correspondingly translated into tighter labor markets, which contributed to a higher peak and more persistence in services inflation this time around. Tight conditions in the labor market explains why pandemic-era monetary policies have had a more pronounced effect on driving up core inflation compared to the previous wave of unconventional monetary policies witnessed during the 2015 to 2018 period. The global inflation landscape exhibited broadening disparity in inflation rates during the 2022 surge, tilted towards an upward skew. However, this trend has since started to normalize. There is a notable decline in services activity, coinciding with a persistent deceleration in manufacturing. This hints at a potential drop in services inflation for 2024 and a likely softening in both labor markets and overall economic activity. Despite the prevailing tightness in labor markets, notably in the United States, a recent drop in the ratio of job vacancies to the number of unemployed individuals indicates a further potential easing in wage growth. Moreover, there isn't much evidence to support the existence of a so-called wage price spiral in which rising wages lead to higher prices, which in turn trigger demands for even higher wages, perpetuating inflation. Part of the deceleration in inflation can also be attributed to the implementation of more restrictive monetary policies necessary to curb price pressures. This tightening is beginning to have an impact, although its effects vary across nations. Restrictions in credit availability are placing a burden on housing markets, investment, and overall economic activity, especially in countries with a higher proportion of adjustable rate mortgages or where households are less inclined or financially able to access their savings. Notably, corporate insolvencies have seen an uptick in both the US and the euro area, albeit rising from historically low levels. Furthermore, countries are positioned at various stages of their tightening cycles. Advanced economies, excluding Japan, are approaching the zenith, while certain emerging market economies, like Brazil and Chile, have already commenced easing measures. According to the International Monetary Fund, or IMF, global headline inflation has more than halved, plummeting from its peak of around 11.6% in the second quarter of last year in quarterly annualized terms to 5.3% in the corresponding quarter of 2023. This represents a closure of approximately 4/5 of the gap between the peak in inflation in 2022 and the 3.5% average in the 3 years leading up to the pandemic. While both headline and core inflation have come down, they remain uncomfortably high. The IMF expects global headline inflation to decline steadily from 8.7% last year to an average of 6.9% this year and 5.8% for next year. Despite this projected deceleration, forecasts for this year and next were revised up by 0.1% and 0.6% respectively in the IMF's October World Economic Outlook. Moreover, inflation is not expected to return to target until 2025 in most cases. The IMF's forecasts show that the pace of expected disinflation is likely to be more pronounced for advanced nations due to stronger monetary policy frameworks and good central bank communication. Moreover, a lower exposure to commodity price changes and exchange rates also allows for a quicker slowdown in overall inflation. The IMF predicts that this year, average annual inflation will exceed targets for 93% of the 72 inflation targeting countries worldwide. The most notable deviation from this trend is China, where headline inflation remains contained and falls below the authority's set target. The People's Bank of China has responded to low inflation and substantial economic slack by implementing interest rate cuts in both June and in August. Thailand and Vietnam are also outliers in this regard due to a strong pass-through from lower energy prices, lower house price inflation, and slower economic activity, respectively. In 2024, the IMF anticipates that about 89% of economies will surpass their inflation targets or the midpoint thereof. The projected median deviation is approximately 1 percentage point. Looking ahead to 2025, most economies are expected to narrow this gap substantially, with inflation staying within a slim margin of 0.2 percentage points from their respective targets. Core inflation is anticipated to experience a more gradual decline compared to headline inflation. On a global scale, the IMF expects a modest reduction, shifting from an average 6.4% last year to 6.3% this year and further to 5.3% in 2024. Notably, core inflation is anticipated to display a higher level of persistence than we initially thought. The IMF expects that more than half of global economies are expected to witness no decrease in core inflation throughout this year. The IMF has upwardly revised its core inflation projections by 0.3 percentage points for 2023 and 0.6 percentage points for 2024 in October relative to July to reflect stickier underlying price pressures. Despite resolute actions taken by global central banks and the likelihood that they are nearing the peak of their previously synchronized tightening cycles, inflation continues to surpass targets in nearly all economies with an inflation target. As such, cutting interest rates too soon could squander the gains by monetary policy tightening in the past 2 years. Adding to the challenge, recent market unease regarding an escalation of conflict in the Mideast has further constrained supply in international oil markets. This presents an upside risk to inflation. According to the IMF, a 30% surge in oil prices relative to baseline assumptions, which we know are around an average of $80 per barrel for this year next, could potentially lower GDP growth by 0.5% and raise global inflation by an additional 1.3%. In our view, central banks have been more inclined to accepting a short and mild recession rather than completely relinquishing control over price pressures, given that once the metaphorical inflation genie is out of the bottle, reining in future price expectations becomes an arduous task. Long-term inflation expectations have been reasonably stable, exerting minimal influence on recent shifts in core inflation. This stability is a testament to the advantages garnered from decades of a low inflation environment and the credibility established by central banks. Encouragingly, there is a notable benefit in having inflation expectations pivot toward a more forward-looking perspective rather than being heavily tethered to past inflation experiences. Research from the IMF underscores the efficacy of central banks in steering inflation expectations. The more proficient policymakers are in shaping these expectations, the lower the associated costs in terms of sacrificed economic output when central banks endeavor to meet their inflation goals. Conversely, in a scenario where inflation expectations dwell predominantly on historical trends, which is more typical of emerging markets in general, there's a risk of participants expecting inflation to be permanently higher in an already high inflation environment. This could lead to a potential de-anchoring of inflation expectations, and this amplifies the growth and inflation challenges faced by monetary policy makers. A swift rise in interest rates in major advanced economies since the start of 2022 was a crucial reaction to a surge in inflation. These rate hikes have led to tight monetary policy stances, with real rates rising above neutral, and this is projected to persist well into 2025. Evidently, the effects of this tighter monetary policy are beginning to permeate the real economy. Lending surveys conducted in both the US and Europe demonstrate that banks significantly curtailed access to credit throughout the past year, with indications pointing to a continuation of this trend in the coming months. Moreover, there are clear signs that increasingly stringent credit conditions are starting to impact real economic activity. Despite this, real economic activity remains relatively robust, aligning projections more closely with the scenario of a so-called soft landing, an easing of inflation without a substantial downturn in activity. Nevertheless, notable disparities are emerging. The deceleration is notably sharper in advanced economies compared to their emerging counterparts. Additionally, there is a noticeable shift towards less synchronization in monetary policy changes, as certain central banks that implemented tightening measures earlier, such as the Central Bank of Brazil, are now commencing their easing cycles. Bringing it closer to home, the South African Reserve Bank maintains a firm resolve to get the inflation genie back into the bottle and keep it there. The SARB has maintained a tight stance on monetary policy despite a slowing in economic activity to address the persistence of upside risks to inflation. On numerous occasions, the bank has emphasized the dangers of too high inflation, especially for the less privileged, whether stemming from domestic demand, power disruptions, or external shocks beyond the country's control. As such, even during an economic slowdown, the bank is obliged to tackle second-round inflationary effects and mitigate a rise in inflation expectations, all while prioritizing long-term economic stability. As with global central banks, the future path of policy rates and the timing of the first interest rate cut in South Africa will hinge on whether monetary authorities feel confident enough that disinflation is progressing in line with expectations. In other words, whether inflation will subside to 4.5% on a more sustainable basis in the coming quarters. So how do we bottle the inflation genie once it's out? The solution, we believe, lies in a multifaceted approach involving monetary policy, fiscal interventions, and raising public awareness. We've highlighted 7 areas which should be considered by authorities when tackling inflation. Firstly, effectively containing an inflationary surge necessitates central banks using their array of monetary policy tools where appropriate. These can include interest rates, reserve requirements, and open market operations. These tools can be calibrated to directly address inflationary pressures without unduly impeding economic growth. Secondly, enhanced data analysis offers the potential to spot early indicators of inflationary pressures in a more forward-looking approach. This early detection empowers policymakers to proactively address the inflationary stress, potentially mitigating the extent of required interest rate hikes to curb price pressures. Thirdly, monetary policy needs to work hand in hand with fiscal policy to ensure that actions are aligned to control inflation. Adhering to fiscal consolidation, curbing wasteful expenditures, and improving efficiencies in tax revenue collection can all help to reduce inflationary pressures. More efficient government spending can help grow productive capacity in the economy and improve economic resilience. In South Africa's case, the SARB has warned of the dangers associated with fiscal dominance. Fiscal policy has become less responsive to rising sovereign debt stock in recent years. This compromises the SARB's ability to keep inflation in check while ensuring macroeconomic stability, particularly in an environment where structural bottlenecks limit the country's growth prospects. Fourthly, governments have learned that disruptions in concentrated global supply chains can spur cost-push inflation. Diversifying sources of cost-effective supply and better management of inventory can improve price stability, while improving foreign government policies are crucial to increase the flow of trade. The fifth measure, frequently advocated by multilateral institutions, underscores the importance of encouraging competition within product and labor markets to drive down prices faced by consumers. Sixth, matching pay with productivity, particularly in the public sector in South Africa's case, is crucial to prevent a wage price spiral from taking hold. Understanding the perils of second-round inflationary pressures can also assist in the dialogue of wage-setting arrangements. And finally, expectations about future inflation plays an important role in driving inflation outcomes through its effects on consumption and investment decisions, which then in turn affect prices and wages. We believe that central banks do have the capacity to promote a forward-looking approach to inflation expectations by upholding the independence, the transparency, and credibility of monetary policy. In the days of Reagan's presidency, marked by rampant inflation, challenges abounded. Today's policymakers, armed with diverse tools and knowledge, grapple with the same inflationary beast. Just as Reagan did, they strive to wrestle the genie back into the bottle while ensuring the resilience and stability of the economic fabric. Acknowledging that the inflation genie can escape its confines due to a multitude of reasons, the imperative lies in a more nuanced approach, combining monetary acumen, timely policy adjustments, vigilant fiscal strategies, and fostering a forward-looking mindset amongst consumers and businesses in this current era of global economic shocks. I thank you for your time.
Thanks for sharing such a great insight, Sanisha. Next, Mike Atsets, our Chief Investment Officer, will have a discussion with Robert Graver from Crown Agents Investments Management and give you a global overview of inflation and interest rates. Pleasure to have you join us today, Mike and Robert.
Thank you, Mike, and good day to everyone. Joining me in the studio today is Robert Sgraver, the Chief Executive Officer of Crown Agents Investment Management, or as we like to call them, CAIM. CAIM is a recent addition to the Momentum family, and before we dive into inflation, fixed interest in the developed markets, I just want to give Robert an opportunity to give us a little bit of his background and also talk about Crown Agents, a fascinating story that stretches back to the late 1700s. So Robert, could you please introduce yourself and introduce Crown Agents to our listeners?
Great, thank you, Mike. It's a pleasure to be here. Crown Agents Investment Management, as Mike mentioned, has been around for quite a long time. We can trace our roots back to the 1700s. Our predecessor organizations have been providing financial services since the 1800s. And we've been working with institutional investors since the 1960s, with a particular focus on official institutions and central banks, with whom we have our longest client on the books has been with us since the 1980s. We are generally an institutional investment management shop. We are entirely invested in public market, developed market investments, directly invested by our own portfolio managers. And for each of our institutional clients, we're not necessarily putting together products, but we're putting together specific bespoke solutions for them with customized asset allocation and custom guidelines. As far as I'm concerned, I've only been with CAIM for about 3.5 years now. I do have a career that stretches back in global institutional investment management for nearly 30 years. I've been in larger asset management firms. I have been in the World Bank twice as a consultant and a advisor to other institutional investors, and I've also run their quantitative strategies risk and analytics group. I've been a central bank portfolio manager and chief investment officer for 11 years of my life in the country of Latvia, a bit north of here. And during the course of my career, I have been able to do business, or at least travel on business, to 96 countries now and counting.
That's quite an achievement, and we look forward to having you in the family. Now let's dive right into it. Your focus is on developed market fixed interest, and we are in a fascinating territory. We are seeing some stickiness in inflation, and a lot of global events are preluding that the stickiness and the inflation trajectory might be a little bit around for a little bit longer. Can you just give me your perspectives, how you're seeing the current environment around interest rates, inflation, and what your perceived trajectory is?
Sure. So on the inflation side, inflation is the reason we're in all of this mess in capital markets in the first place, right? With 2022 being a very volatile and very adverse year for fixed income investors, especially, but also equity investors. In hindsight, it's easy to point fingers and look at developed market central banks for being too accommodative with unconventional monetary policies for too long, and then being too late to the party to start raising interest rates. And when they did, of course, we've had quite a dramatic adjustment in rates and markets and expectations. On the inflation side, though, clearly inflation has been very, very high and at very high levels for developed markets, at least for quite some time. But I think the trajectory is on the positive side now, and I think that's something that the market would generally agree with as well. We've had central banks starting to think about pausing or actually pausing their rate hikes. And as a consequence of rates being high at these high levels where they are now, many of the central banks have been communicating that they're happy to leave rates at these levels and leave the high interest rates and high cost of capital to do their job in bringing down inflation even further. So we've seen, at the time of this filming last week, core PCE numbers in the US came down slightly. We have seen in the UK, which still has higher inflation than the rest of the US and the Eurozone, but those numbers have been ticking down as well. We're expecting some inflation prints soon in the Eurozone, with the expectation that they come down as well. So generally, we feel that inflation is and has been problematic, but the trajectory is on the right path. The lack of monetary policy accommodation, or actually the tightening, will actually continue to help bring inflation down further. And if you think about how the market has been discussing things, clearly inflation had been front and center during the earlier parts of last year and late 2021, and throughout the hiking cycle as well. But inflation doesn't necessarily seem to be the front burner topic for many market analysts and pundits. We have other things to worry about in the world.
Roberts, rewinding back 2 years, our expectation was the inflation would roll over and come down a lot quicker than it has. And we've seen that inflation has been stickier than a lot of people have expected or market pundits have expected. And even the views on where the new equilibrium rate of inflation is going to be higher than it has been in the past. There are a lot of risks in the system and potential exogenous shocks. That means that although we have a view that we're probably at the top of the interest rate hiking cycle, there are a lot of risks in the system. Just your views in terms of the inflation trajectory, stickiness, and what you're thinking about of potential exogenous shocks that you're keeping an eye out for.
Thanks. I'm in full agreement with the idea that inflation is sticky and probably higher than many would have expected this time last year. There's several reasons for that. Some of the exogenous shocks, as you mentioned. The ECB has mentioned very recently that they do expect inflation to remain too high for too long, but they do think also that the higher rates should be able to do their job in terms of monetary policy and bringing things down to a possibly higher neutral level. On the exogenous shock side, we've seen quite dramatic ones over the past couple of years. I don't think any one of us a year ago or 2 years ago would have expected to see land war in Europe. And the Russian aggression in Ukraine continues with consequences certainly for the Ukrainians and everyone involved in that conflict, which it's a horrible human catastrophe. I think, and with the obvious knock-on effects that the effect on energy prices was quite acute. And continues to be, especially in European countries that rely on energy from that part of the world. We also have, of course, the unfortunate tragedy in Israel as well, with the aggression there by Hamas and then the terrible loss of human life everywhere. From a global market perspective, it hasn't appeared to have been a major financial or economic development or influence yet. Obviously, that could change if the conflict escalates and other parties are brought into the mix. We hope that doesn't happen. But even if it does, we would expect the global, the financial prospects of things to be gradual, likely with the effect on continued high energy prices.
I sincerely hope that cooler heads prevail and that we do get to a situation where realism and pragmatism comes to the fore again, and we manage to navigate this geopolitical environment.
Yeah, I agree. We do have the US elections ahead next year as well, and the outcome of which could also very much influence geopolitics and trajectories of countries and economics. From an investment perspective, however, it's very difficult to use this as tradable information, right? So it's hard enough for investors to try to make sense of economic and fiscal developments and market developments to try to make informed choices in the face of incomplete information. It's an order of magnitude more difficult to try to forecast the timing and outcomes and consequences of geopolitical things. So the best we can do is try to remain aware and nimble and responsive when things do occur.
And I mean, that's the fascinating thing about the environment. It's constantly changing. And I am going to ask you a question in terms of your views and positioning. A couple of years ago, we had an acronym in South Africa called TINA, There Is No Alternative, which meant that you invested into developed market equities. As interest rates have increased, fixed interest became investable again, but generally it is around the cash type investments, the shorter duration, and the longer out you go in duration, the more risk there is. But importantly, we get into an environment where if we are at the top of the interest rate cycle, you really need to start thinking about your duration in portfolios, and cash has been a better investment. But when the expectations of interest rates coming off and interest rates in fact coming down, the longer parts of the duration spectrum of the fixed interest complex becomes a lot more appealing and investable. Just how are you thinking in terms of placement of assets, duration, along the yield curve and how you see the opportunities set unfolding over the next 12 to 18 months.
Great, thanks, Mike. Well, there's a few things to unpack there. First of all, let's talk about whether or not we are at the end of the rate hike cycles or not. I mean, we think clearly we're closer to the end of hikes than we are to the middle of them or the beginning of them. I think, the ECB just paused. We expect the Fed to pause for a bit as well. They may or may not face pressure to maybe do one or a couple of more hikes in later December, early next year. But generally, we think that the hiking cycle is kind of close. And the Fed chairman also discussed, I think last week or as of this taping, that they also expect the consequences of higher rates in the long end to do more of the fiscal tightening as well, which implies that the Fed has less that they need to do on the policy rate side. In England, things are a bit stickier in terms of inflation, but we also expect the Bank of England to remain on hold for a bit, although they might face some tightening and hiking pressures a bit further down the road. So with that said, we do believe that we are at the near the end of the hiking cycle, if not at the exact end of it. I mean, nobody rings a bell at the top of markets or bottom of markets, but we think we're there.
And politicians are trying their level best to upset the apple cart.
That's right. That's right. So, but now where we are at in an environment of higher rates in fixed income, we really haven't been here for quite a long time. Ever since the global financial crisis, it's almost nearly 15 years ago now, but it feels much more close in history to my heart, having lived through it. We might have a whole universe of young professionals and young investors who have never experienced what it's like to live in a world where you actually have fixed income instruments with yield in them. Yeah. And when you do have instruments with yield in them, as we do now, there's a compelling case to think about, the whole stock bond tilt and thinking about fixed income or more exposures to fixed income in a balanced portfolio, which we do see amongst our clients, which we do recommend as well. In fixed income, as you mentioned, in many of the developed markets, the yield curves are inverted, which means that the short end is higher in yield than the long end. And if you were considering the idea that yield curves would remain unchanged, that clearly the smart thing to do is put as much money as you can in cash, which has the highest yield and the least interest rate risk. We would caution, however, that it's important to invest for where we're going and not where we are. So if you think about the idea that the rate cycle is near the top, if you think about the idea that market consensus is generally, in the US at least, by this time next year, we should see yields about 100 basis points lower on the short end and the long end, and even more moves downward in the belly part of the curve, then one needs to start thinking about the impact of duration in portfolios and what that means. Because if rates start going down, cash investors will start receiving a lower income as they reinvest at lower rates. And while yields will be going down, the consequences are actually quite positive for investors in fixed income with duration. So when yields go down, prices go up, and the more duration one has in a portfolio, the bigger that effect is. So as an example, if the market goes to what market consensus expects in the US over the next year, you would earn about 5%, slightly below, it's just rounded up, holding cash. If you were in the 2-year maturity space, you would earn about 7%. If you were in the 5-year space, you could earn 10%. The 10-year would earn north of 15, and the 30-year would earn north of 25. So there's quite a lot of kick involved in yields starting to move down, and those returns look really quite attractive, even in comparison to equities. Just on the coupon side, where we have higher yields and the dividend yield of the S&P is only 1.7%, that makes an interesting cash argument as well.
I mean, that's a good point. You invest through the cycle and always take the opportunities when they arise.
Yeah.
Now, the inverted yield curve is generally the strongest indicator of a recession or recession risk, and we seem to be in a Goldilocks environment where the recession is always hovering but never quite close. And there's a lot more talk about a soft landing versus a hard recession. Just your views in terms of recession risks and what to keep out for.
Yeah, you're right. I think a year ago, most market participants were forecasting the U.S. being in heavy recession right now, and that hasn't occurred. The U.S. economy specifically has been much more robust than expected, which is a good thing, because then we don't have the pain of moving into recession. I wouldn't necessarily put all of my eggs in the basket of remaining in soft landing space. If you look at some of the forward-looking economic indicators, like for the consumer, the credit card balances and consumer delinquencies. In the housing space, you have higher mortgage starts and less mortgage applications and lower housing starts. So all of those do flag the risks of recession going forward. But for the time being, we're not thinking about actually heading into recession anytime soon. Europe is clearly slightly weaker and also more vulnerable to threats. And depending on which country in Europe you're looking at, they're actually at negative GDP anyway. But the general outlook is that we might be heading towards a soft landing-ish sort of thing. In any event, yields at these high levels are also generally unsustainable. So the cost of capital is too high, and it'll make it difficult to drive forward-looking economic growth strongly. So from that perspective as well, policymakers are interested in getting things down a bit and moderating.
Unfortunately, we don't have a crystal ball.
No.
The challenge of portfolio management is always kind of looking at what happens into the future and having a sound risk management framework. So you are taking sensible risks and you are taking risk in the portfolio, but not unduly so. So one of the free lunches in investments is diversification. So before we conclude the conversation, you do have a huge focus on developed market bonds. I just want to ask about your views on some of the adjacent investments, the credit markets, and where are you potentially seeing other investment opportunities in the fixed interest sensitive space?
Sure. So on balance, we are very strong proponents of diversification in whatever asset universe you might be working with. So if it's a balanced context, then clearly you need both equities and fixed income and possibly alternatives, depending on where you are in your investment universe. And in fixed income, diversification helps. If you believe in things like term premia, which more duration should over the long horizon earn more than cash, then you want to own bonds. If you believe in things like risk premia and spread premia, then you want to own corporate bonds and credit versus just purely government bonds. So from a strategic perspective, yes, you need to have exposures to various different bits and pieces. Actually, corporates tend to provide protection at sometimes during adverse periods for government bonds, not necessarily in 2022 when all yields went up quite dramatically, but it's a good diversifier. From a tactical perspective, however, we don't necessarily believe that spreads where they are now, either in investment grade or in high yield, look particularly attractive versus the alternatives. We may not be heading into a deep recession, but we are likely to be heading into slower growth, and therefore slower earnings growth unless strong corporate balance sheets and all of the consequences there, which means that you're not necessarily compensated for owning the credit risk that you have as much as you could be. But we would be certainly buyers of credit as and when yields and spreads go back up again.
Okay. So clearly we've moved away from there's no alternative, and fixed interest, especially global fixed interest, has become an investable asset class again. Going forward, there are going to be risks and opportunities, but once again, it really talks around the need for portfolio management and being aware and attuned to what's happening around the world. So Robert, it's been an absolute pleasure having you in the studio with us. I've loved the conversation, and thank you very much.
Well, thanks, Mike. It's been a delight to be here. We're happy to be part of the Momentum Group now, and we're quite happy to talk to your audiences as well.
Thank you.
Thanks, Mike and Roberts. Definitely one space to keep an eye on. And now, Zisanda Gila, one of our fixed income fund managers, will explain why cash is king and the opportunities at the moment. Welcome, Zisanda.
Thank you, Mike. Good day, and thank you for joining us virtually on today's topic covering the cash markets. My name is Zisanda Gila, a portfolio manager at Momentum Investments. The role of various central banks and financial regulators is to promote a stable and resilient global financial system. I would like to kick off today's presentation with a slide that supports this statement. Over the past couple of years, the financial markets have experienced different economic challenges which have forced the central banks to react to the pressures these had on the economies through the use of monetary policy tools. COVID-19 outbreak in 2020, which did not only threaten to wipe out humanity, but created unprecedented challenges and instability in economies and markets around the world. For a period of over 20 months, most central banks took action to ease monetary policy, providing liquidity to markets and stimulate economic growth. Some even took short-term policy rates below 0%. After the lockdown regulations had been relaxed, the economies showed signs of recovery. The IMF even revised the global growth forecast upwards based on how well the pandemic continues to be controlled, the efficacy of fiscal policy in mitigating economic damage, and global financial conditions. Now, interest rates were on all-time lows. Around March 2021, emerging market peers such as Turkey, Brazil, Russia, and Ukraine, and other central banks such as Chile, Poland, and Mexico started hiking interest rates mainly because of high and rising inflation in these countries, which had risen well past the central bank inflation targets. At this point, the developed market central banks, the US Fed, Bank of England, and the European Central Bank, were in no hurry to undo easing measures. Russia's invasion of Ukraine in February 2022 sparked even higher inflationary pressures as global oil prices, food prices, and prices of other goods and services rose significantly. In response to rapidly growing inflation, the central banks around the world tightened monetary policy by increasing interest rates. In recent months, global inflation has been trending down, but policy rates are expected to remain high for longer than previously anticipated. This was the theme across most of the developed markets' central banks in their September meetings. Chile's central bank became the first among the 5 most independent Latin American central banks to start cutting the policy rates by a significant 100 basis points to 10.25%, even though the underlying inflation remains well above the official target. And Brazil and Poland also followed, now in September. Having said that, it has been noted that in cases of extreme volatility and uncertainty in the market, these are not an accurate predictor of the actual policy rate decisions. During the global financial crisis in 2008, short-dated forward rate agreements declined too soon by up to 250 basis points, but the repo recorded a decline of only 50 basis points. And continuing into 2009, the forward rate agreements declined too soon by almost 345 basis points, and repo dropped by 100 basis points. The repo subsequently caught up and closed the gap and later diverged into positive territory, maintaining a spread of equivalent to 25 basis points. Again, 2018 was recorded as the worst year for the markets in over a decade after the stock market crash, fueled by a slowdown in economic growth of the big world economies. US-China trade tensions, concerns that the Fed was raising interest rates too quickly, and threats of a no-deal Brexit by the US president. All these factors and others I might not have mentioned resulted in the gap in pricing widening again. The 2020 COVID-19 pandemic is a recent example of this decoupling, where the markets got excited and priced in more rate cuts and later self-corrected. However, in perfect market conditions, as I mentioned earlier, these rates are correlated, and the 3-month forward rate paves the way for the repo rate. You may be familiar with the phrase, "When America sneezes, the world catches a cold." which translates loosely to mean that whatever happens in America affects the rest of the world, be it good or bad. One of the key drivers of policy rate changes is inflation. In an environment where high inflation takes the center stage, central banks use interest rate as a tool to control it within each bank's target band. As they have confronted price stability challenges, they now have to also face new financial stability risks, with some related to the sizable moves in interest rates in an environment with persistent elevated inflation. The recent macroeconomic experience has presented both monetary policy and financial stability challenges for central banks. Many central banks facing these dynamics have tightened monetary policy to bring demand and supply into better balance and to bring inflation back down to their targets. Over the past year and a half, the Federal Open Market Committee, the FOMC, has increased the federal fund rate by 5.25%. We have seen some impact this had on lowering inflation over that time. However, inflation remains well above their 2% target. Domestic spending in the US has continued at a strong pace and the labor market remains tight. This suggests that the policy rate may need to raise further and stay restrictive for some time to return inflation to the FOMC's goal. Locally here in South Africa, after the 475 basis points worth of interest rate hikes since November 2021, it seems that the rate hiking cycle has ended. Whereas the risk assessment of the inflation outlook remains to the upside, the SARB has revised its near-term inflation outlook lower. Due to downside surprises to inflation outcome in July and August, we expect inflation to remain on its glide path towards the midpoint of the target band on a more sustainable basis. South African interest rates are likely to stay on hold until the second quarter of 2024 to counter fiscal dominance risks and continued upside risks to the inflation profile. The FRA curve continues to flatten with the back end lower and the front end well contained, and with only a very small chance of a rate hike at the next meeting. Even in the cash market kingdom, not all heirs are equal. The various asset types in the money market space have delivered decent performance over time. Firstly, the treasury bills. Treasury bills are issued by the National Treasury as a short-term funding instrument, also used as a tool to manage the government's liquidity. They are deemed risk-free and are linked to government. The demand on the 3-month treasury bill tapered off as the yield got unattractive. The red bars indicate a period between October 2022 and March 2023 where the 3-month treasury bills underperformed bank NCDs by almost 100 basis points. The market was pricing in some fiscal risks in the short term, driven by what was happening globally. And investors were finding investment opportunities within the banking sector to deploy their cash in the 3-month space. However, beyond this point, investors were seeing value in the longer dated treasury bills, with bid to cover ratios remaining healthy at 2 to 3 times for these tenors. Most bids were in the 6-month area, with spreads as wide as 50 basis points above the NCDs, and also supported by the fact that the spreads remained attractive over bank paper compared to the 9 and 12 months, which had started to shift down in response to the FRA curve. Cash is king. In which kingdom, you may ask? In closing, cash markets or money market assets are strongly correlated to interest rate movements. While in the emerging markets and developing economies, debt pressures are growing due to higher interest rates. Over the interest rate hiking cycle, cash yields have become more attractive in the short end of the curve and offered good investment opportunities for us. We have witnessed a lot of funds flowing into the money market funds from institutions, corporates, and individual investors who have no appetite for risky assets. When we look closely into money market curve, outperformance was recorded in the 1-year NCD, which were trading around 10% 5 months ago. Even if we look at the current levels of around 9.1% and the 1-year inflation at 5.75%, the investors enjoy a level of inflation protection and earn a real yield of 3%. The curve inverts beyond this point, as you can see, which makes the 1-year NCD a top performer when compared to the 18-month, the 2-year, and the 3-year NCDs. Beyond the 1 year, we think the banks are well funded and are meeting requirements when it comes to the net stable funding ratio and the capital adequacy ratios. and therefore not willing to pay up for funding. Hence, they are not pricing aggressively at all. Once again, as you can see, cash is king and cash flow is queen. Thank you.
Thank you, Zizanda. Ian Scott, our head of fixed income, will talk about the future opportunity set of fixed income investments. Take it away, Ian.
Thank you, Mike. Hello, everyone. Today we are going to discuss our best investment view fund called the Momentum Flexible Income Fund. What is the building blocks of this fund? How do we think should a flexible income fund be constructed? We're going to firstly look at all the different building blocks. How do we get there? And towards the latter part of the presentation, we're going to actually look at the fund and we say, well, are we doing what we're saying and saying what we're doing? So let's get into it. Firstly, what's happening in the world? The US matters. Why? Because the Fed sets the global interest rates. So when they move interest rates, the SARB also has to move interest rates. Think about it. A year or two ago, when we were coming out of COVID, interest rates in the US were 0.25%. Now we're up at 5.25%. Interest rates in South Africa, the repo rate was 3.75. Now we're at 8.25%. It matters. So every time the Fed moves the interest rates and bond yields move, the South African bond yield should also move. Think about it. 2 years ago, the US bond yield was probably around 30 basis points. Now we're up at 5%. The South African 10-year rate, closer to 9%. Now we're up closer to 12%. It shows you when the globe moves, we have to move. We have to anticipate it. What does it mean? What does it mean for valuation? What happens in the US affects Europe, the UK, all the continents. Being a global economy, it means South Africa has to follow. Right, so now we know, building block 1, US, if it moves, we will have to follow. But it's not an all fall down scenario, because we think that corporates in the US are actually very strong. Think about it, we've had this massive move in interest rates. Now typically what you would see when interest rates move a lot, US corporates start to default. What are we seeing? The US corporate balance sheets are actually in a very, very good condition. Very low defaults. Very low non-performing loans in the banking sector. What does it mean? Low spreads. So when this graph moves up, it means a lot of risk in the market. Lots of defaults in the US economy, which is negative for emerging markets. What are we seeing at the moment? Low defaults. It's good for emerging markets. Credits look good. So yes, we want to be investors in US credits. We think there's a good opportunity there. Building block 2 for the flexible income fund. US corporate spreads look very attractive at the moment. So what has happened to developed market bonds? Well, as we said, they all moved higher. Remember we said the US moved from 30 basis points up to 5%. We've seen very similar moves. European bonds, UK bonds, Japanese bonds, yes, albeit at a lower level, but the trend is the same. That's why we've seen emerging market bonds move as well. What does it say to us? Bonds are cheap. Yes, they were cheap probably 2 years ago, but now they're a lot cheaper. And we think, yes, we think there's a good opportunity for a flexible fund to be exposed to various duration bonds across the globe. So that's what's happened globally. So let's look what's happened in domestic markets. Firstly, money markets. We all know that the SARB has hiked rates all the way up to 8.25%. What does it mean? It actually means for the first time in about 3 years, there's very attractive real yields available in South Africa. Think about where inflation is, around 5.5%, and we can invest 1 year NCDs around 9%. Wow, 3.5% real in cash, that's really your safest asset class. That's a big tick for assets in our flexible income fund. So cash, definitely a winner at the moment. What is the market pricing for interest rates? It says, well, interest rates in South Africa is probably at the top at 8.25%. Yes, there may be a probability that they could still hike interest rates towards the latter part of this year, may or may not. But what's more important is that the market is actually starting to price for interest rate cuts from the middle of next year. The FRA market says, look, the SARB has hiked rates all the way. It's probably going to be steady for the next 6 months or so. And when we get closer to the middle of 2024, well, let's hold on, because then the SARB might actually cut rates, which will be a good thing for our assets, good for the economy, good for various different asset classes in South Africa. We're probably going to see a very similar trajectory from the Fed, that the Fed will probably go on hold as well and also start cutting rates somewhere in the middle of 2024. So watch out. I think there's good opportunities in South African fixed income in the next 6 months. If we move to the credit market, what's happening there? And we're talking about the listed, rated market in South Africa. Well, we've seen about 130 billion of issuance in this market. Quite a lot. It's basically been dominated by the banking sector. So the banks in South Africa really want to use the opportunity to lever their balance sheets because they think there's opportunities. They issue a lot of debt at the moment. Not always at attractive levels, but we'll get into that. We've seen a little bit of corporate action in South Africa where for years now we've seen industrials and mines and retailers not really being that active in the South African market. Over the last 6 months or more, we've really seen a lot of these corporates coming back into the South African market, issuing term debt, levering up the balance sheets. But it doesn't concern us because we think that the overall balance sheet of corporate South Africa looks very attractive. So another tick for that flexible income fund. We think corporate credit looks attractive to us. Yes, when we get into the pricing now, it's not that attractive. But remember, as a value asset manager, it's always our mission to find that diamond between all the rocks. We dig through those rocks to find that diamond. Yes, it's probably not that easy to find. But what we are saying is that the market is actually pricing spreads very tightly, or the prices are actually high of South African corporate credit. But what's important in that statement is that the quality is also high. So we think that the probability of default of South African corporates are actually very low. It means when we buy a Bidvest or a Sasol into our portfolios, yes, the pricing might not be that great, but the quality is very high. The probability of default is actually very low. So yes, another tick for our flexible fund. Do we want to own corporate credit? For sure, at the right price. So as we go along, you can clearly see that there's a lot of ticks for a lot of asset classes that's making a claim to have an allocation in our flexible fund. Okay, so now we talked around the short-dated asset classes, but what's happened in duration assets? Well, let's have a look. Bonds, wow, it's been a rough ride up. Remember we said the US 10-year all the way from around 30 basis points up to 5%. South African bond yields, let's say sub 8% over the last 3 years, all the way up to 12%. It's been a very, very rocky ride. But now, if you think about it, inflation is 5.5%. Next year, probably closer to 5%. 12% yields. When you talk around 6.5% real yields in government bonds above inflation, wow, guys, that's a big tick, saying that this is an asset class that's making a play for our flexible income fund. It should be there. Let's have a look. This is the South African yield curve, right? So now we say, well, what does that term structure of South African long-dated rates look like? Very, very steep, right? It means the market is pricing for a lot of negative news in the South African yield curve. So yes, we know about Eskom. We know about Transnet. I think the news is full of this stories with the Minister of Finance. What is he going to do in the various budgets coming, right? There is a fiscal issue. That's fine. But to us, we say, well, what is already in the price? Yes, we know about these negative things, but the curve prices for it. And we think a lot of the negative news around the South African fiscal position has already been priced. Because think about it, at inflation plus 7, it means there's a big risk premium already in the South African market. So we believe that South African bonds really has a place in that flexible income fund. Why? Because it looks so attractive on a nominal and on a real basis. Talking about real yields, where's real yields in South Africa? Well, let's have a look. Inflation-linked bonds. Now remember, inflation-linked bonds is that protection instrument in fixed income. When inflation moves up, it protects you. What has happened? Well, those yields have also moved up. We think there's great real yields in South Africa. Why? Think about it. The 10-year inflation bond in South Africa is sitting at 5% real. We're talking about equity type returns in a fixed income asset class with a SARB guarantee. Because if inflation moves out, the SARB is gonna hike rates. So you basically get an implicit guarantee. So if we look what that curve looks like, also very steep, very elevated, 5% real yields on 10 years. I think that's an asset class that should be in our flexible income fund. So once again, you can clearly see when we go through all these different asset classes, lots of these assets actually make a play to be in our fund. It's becoming actually quite difficult for us to say, well, all these asset classes look so attractive, where are we actually going to allocate assets? Well, that's always the fun and the art of fund management. And that's what we're trying to do for our clients, because think about it, when we speak to clients, what do you always ask me? You always say, Ian, should I be in cash? Should I be in inflation bond? Should I be in nominal bond? Should I go offshore? Well, we think the flexible income fund is that solution where we actually as a team decide where we think the best opportunities should be for you as our investors. So let's go and have a look at that fund. So what is a flexible income fund? Well, it's our team's, the fixed income team's best investment view across the 6 yield curves that we manage assets for you as our investors. Yes, it has prudential limits, so we can go offshore. We can actually get into that offshore credit. It looks attractive to us. Yes, we can go into property up to 10%, and you will go, property, what are you talking about? Well, we think there's 1 or 2 diamonds in property. We think there's opportunity. Not everything in the property sector is rocks. There's 1 or 2 diamonds. There's a low duration risk profile to it. So yes, it's not a money market fund, but it's also not a bond fund. But we would say to you, if you invest in a flexible income fund, please, it's not a parking bay for cash. It's not a money market fund. Please, we think that you should be there for at least 2 to 3 years so you can actually run through a full interest rate cycle. What we don't want to do, and what we've seen in quite a few of these funds, is actually active foreign exchange risk. So be it. We've taken a decision in our team to say, we will take interest rate risk, duration risk, credit risk in our portfolio, but not FX risk. So all our offshore FX exposures are hedged. So we're not taking rand risk in our portfolio. We believe this is not the type of portfolio that should take foreign exchange risks. Right, now we've talked around it. What does that portfolio actually look like? Right, we said to you, cash looks attractive, so you'll see a cash portion there. Remember, cash is fighting power. We always want to have cash in the portfolio, so when markets sell off, we can actually apply capital. You're going to see a lot of credit there. Local credit as well as offshore credit. Why? We said to you, lots of safety. There are very interesting spreads, yields in the credit market. Nominal bonds. Why? Because we cannot ignore the 5, 6, 7% real yields of nominal bonds. You're going to see inflation bonds. Once again, you say, why? Because inflation is falling. I'd say yes, but that's why the real yields are very high. Remember, when inflation falls, real yields rise, and we say, well, at the 10-year point, when you get 5% real yields, we cannot ignore that. We've got to have some inflation bonds in our portfolio. Property. We talked around properties, but we're not going to buy all properties. We are selectively going to buy property stocks and REITs where we say, well, look, these guys have taken a proper revaluation of the valuation on their properties. Expectations are low. Prices are low. We think there's a good opportunity in property. And if the SARB starts cutting rates, this will be an asset class that really benefits from a lower interest rate environment in 2024. When we move to where we're exposed on the duration side, we would say, well, look, this is an income fund. It's not a bond fund. So you would probably find that the bulk of our exposure duration-wise sits somewhere between the 1 to 3 year, 3 to 7 year parts of the bucket. Yes, we do have a little bit of 7 to 12 years. Why? because we cannot ignore the 13% yield that we are finding in that part of the curve. We understand that there's a risk, but we think we are compensated for that risk. So yes, very much centered towards what we call the belly or the middle of the curve. Not a bond fund, not a money market fund, but somewhere in the middle, and also delivering a high level of income for our investors over that 2 to 3 year investment horizon. So looking at the fund, what can we expect over the next year or more from these various asset classes? Right, so we said inflation probably going to be around 5% next year and 4.5% in 2025. So let's firstly look at cash. So we said cash will probably give us around 8.5 to 9% over the next year, maybe a little bit lower because the SARB will cut rates next year. Still very attractive in that front end, but we think there's other opportunities as well. Secondly is credit, so you're probably going to get 9 to 9.5, so also another tick for that flexible income fund. What does the duration asset classes give us? So we talked around the 5% real yields, but remember, real yield does not equate to total return. From a total returns perspective, we probably say around, call it 8 to 9, 9.5%. So very good real yields expected from inflation bonds. And then the one that is a little bit of a lightning rod is bonds. If things should go horribly wrong in South Africa, you're probably going to have at the single-digit returns. But we think there's such a lot of negative news already priced in the curve. We think low double-digit returns from nominal bonds is very achievable in South Africa because of where the curve is. So you can clearly see on those 4 asset classes alone, we should have an allocation in each of them in our flexible income fund, and that's exactly what we did. Right, so what could happen that makes us change this view? What are the good things and the bad things? And it's not all bad in South Africa. So what are the monsters under the bed that concerns us that could really derail our views? Firstly, the fiscal situation is very dire in South Africa. We need the Minister of Finance to come out and tell us how he's going to fix this fiscal issue over the next 2 to 3 years. It's quite important. There is a problem with tax collection because we know that the commodity cycle is not helping our minds. There's not enough taxes on the corporate side. Remember that yield curves are inverted in developed markets. So in the US, the 2-year is much higher than the 30-year, for example. We actually need the Fed, the BOJ, the ECB to cut rates because that will support emerging market yields again. We know that load shedding will probably have to come to an end. And lastly, we know that there will have to be some sort of bailout plan for SOEs and our metros to try and help this fiscal situation. Yes, we know about this. It sits in the press every day, but we think it is priced in the market. So in the end, we say, well, we think our flexible income fund is really that flagship fund where it really sits in the middle of these yield curves. A lot of the risks are priced, but there's very high real yields available for us. Given all these factors, we believe the flexible income fund is correctly positioned to deliver high nominal and real returns over the next 3 years. It is our best investment view fund. You're going to get the best view from our team over the next 3 years, and we think it's a good place to be invested in fixed income. Thank you.
Thank you, Ian. Next, Stanley Bisho, one of our smart beta fund managers, will discuss equities on the hiking path. The stage is all yours, Stanley.
Thanks, Mike. Hello, everyone. This presentation will review the performance of local listed equities during the current rate hiking cycle. Inflation has been and continues to be a dominant macro theme. We've seen a surge in inflation across the globe, with inflation levels reaching multi-decade highs. Among the developed economies, the inflation spike has been felt more acutely in Europe, which has produced double-digit prints. You also see an unfamiliar picture where developed economies have inflation rates that are much higher than South Africa and other emerging market countries. The shift to an accelerated pace of consumer price increases happened suddenly and created an environment that is quite different to the preceding period, starting after the global financial crisis and ending before the COVID outbreak. In that decade or so after the global financial crisis, the policymakers implemented drastic policies to reflate the global economy, but with limited success. The economic growth was slow and labored, and inflation was fairly muted, especially given the unprecedented levels and methods of stimulus injected into the global economy. The low levels of inflation in that period spurred some market commentators to broaden their definition of inflation, to consider the traditional basket of goods and services, but also to consider an alternative basket of investment securities, especially listed shares. Their reading, given this broader definition of inflation, was that the stimulus spurred inflation not in the consumer basket, but rather in asset prices, resulting in inflated equity valuations. Similar to the financial contagion of the global financial crisis, the outbreak of COVID also necessitated drastic policies, both monetary and fiscal, to stabilize the global economy. This time around, however, the stimulus package did result in a surge in consumer price inflation. The current global inflation dynamics have been driven by a combination of demand and supply factors, including commodity prices that were impacted by the Ukraine-Russia conflict, the post-lockdown pent-up demand, which is bolstered by savings and fiscal transfers, especially in the US, the supply chain dislocations and the knock-on impact, including more volatile inventory levels and the de-risking of supply chains via onshoring or nearshoring. This backdrop has created the inflationary environment we are currently navigating. So how have policymakers responded, especially central banks using monetary policy? In short, the response has been resolute. Central bankers are typically well-versed in financial history, and they use these lessons from the past to inform decisions in the present. As mentioned before in our previous sessions, this current period rhymes with the high levels of inflation induced by geopolitics in the 1970s. The key lesson central bankers seem to have taken from that period is that the cost of reducing inflation becomes more painful and expensive if the policy response is measured and delayed. Therefore, central bankers, in their response to inflation, don't want to fall behind the curve. This provides the context for the policy response, in particular the decision by central bankers to front-load their rate hikes. Based on the Bank of International Settlements data, this has been the most synchronized and steep monetary policy tightening in the past 50 years. A staggering 95% of central banks across the world hiked their policy rates since early 2021. For context, historically, the share is usually below 50 and only reached 80% during the oil price shocks of the 1970s. This graph shows the G20 countries and the cumulative change in their policy rates over a 12-month period, measured at the end of June each year since 2020. The numbers show that compared to historical hiking cycles, the pace of rate hikes has been much quicker, and the hiking cycle has been front-loaded to avoid the danger of falling behind the curve. Initially, the increases were 25 basis points, or a quarter of a percentage point. As inflation persisted, central banks then increased the quantum of policy rate hikes per meeting to 0.5%. As inflation kept surging and the debate around transitory versus persistent inflation seemed to have settled, policy rate increments were lifted to 0.75%, 3 times higher than the initial size of the increases. In this graph, you can clearly see the escalating increases. In the 12 months to June 2021, the G20 countries increased policy rates by 12% in total, and by June 2023, the collective increase in policy rates over the preceding 12 months jumped to 90%, an average increase of 4.5% per country. So how can we conceptually think about interest rates so that it informs expectations about the transmission of higher policy rates into capital markets, especially the behavior of listed shares on the JSE. Interest rates are a fundamental theoretical tool in the universe of finance. One way to think about interest rates is that they collapse space and time. How? Let's imagine in the finance universe you are able to clone yourself and you want to sell a $100 bill to your clone on the spot. In this special condition we have manufactured, the fair price for that $100 bill would naturally be $100. There is no space in a physical or geographic sense, but more importantly, there is no space because you have complete and accurate information between the two counterparties. So there is no information asymmetry and uncertainty, therefore there's no risk to account for. Also, there is no time because the transaction is immediate with no time elapsing between the exchange of cash flows. So there is no uncertainty around the timing and the value of future cash flows. However, in reality, financial instruments are an exchange of cash flows separated by space and time. The interest rate, sometimes called the discount rate, is then a conceptual tool to derive a fair price or fundamental value that sets a price for space and time. The present value calculation collapses time, and an expected present value further collapses space by accounting for uncertainty of the timing and value of future cash flows. Given this context, we would then expect higher interest rates to reduce the fair value of financial instruments, all else being equal, because a higher interest rate increases the cost of space and time, so the fair price of assets become lower to compensate for this. In practice, we can see how this plays out in the South African equity market. In this graph, the red lines show the rolling 3-year real return for the JSE All-Share Index. Each point on that red line shows the total return generated by the ALSI in the preceding 3 years after accounting for inflation. The periods shaded in gray mark periods of loosening financial conditions, where the South African Reserve Bank was reducing interest rates. The remaining periods in white, with no shading, marked periods of policy tightening. It's clear from the graph that the interest rates have an influence on the real return of the overall equity market. The impact of interest rate changes is on the momentum of real returns as opposed to the specific level of the real returns. In other words, lower rates tend to lift real returns from the prevailing levels, and conversely, higher rates tend to lower equity real returns from current levels. This is a consistent picture, even though you may have varying lags and varying magnitude of impact in each cycle. The higher real return in March 2023 seems to be an anomaly, but this is likely a base effect that shows the recovery from the sudden and dramatic drop in share prices during the initial outbreak of COVID 3 years prior to this date. It is worthwhile noting interest rates are a key driver of equity real returns, but they are not the only driver. Companies have contended with a tough operating environment, driven by external factors, mostly outside of management's control. South Africa continues to have an unstable supply of electricity, which impacts JSE-listed companies that have operations in South Africa, like food and clothing retailers that have had to deal with the risk of reduced footfall in stores and shorter operating hours. They've also needed to increase their capital expenditure to enable stores to operate on alternative sources of energy. Some companies needed to navigate the aftermath of the civil unrest and floods in KZN. For example, you've seen a major disruption in the production of taxis from KZN plants and a surge in claims experienced by insurers due to damage of property and interruption of business. The deepening problems in the China housing market have faltered China's post-lockdown recovery. A large component of the JSE All-Share Index is exposed to resources companies that rely heavily on the demand from China's vast infrastructure projects. Also, China's historic ability to reflate its economy, export economic growth to the rest of the world, and provide strong tailwinds for JSE-listed companies has not materialized this time around. Other external drivers like the banking failures in the US and geopolitical tensions in Europe and now recently in the Middle East continue to weigh on global risk sentiment. This has an outsized negative impact on emerging market countries, particularly South Africa, which has a small open economy, but with deep and liquid financial markets. All of these factors have an influence on equity market returns, with most of these factors dampening future profit expectations. Looking into the specifics, the graph shows the cumulative asset class and sector returns that have been generated since the start of the rate hikes in South Africa. Overall, equity market returns have been low relative to their own history, but also low relative to inflation and bonds. That is not the complete picture, however. If you drill down into the all-share return, there has been a significant dispersion in returns by sector. Financials have generated a substantially stronger performance when compared to industrials and resources. Resources have generated the lowest return on the back of lower commodity prices, dampened by low demand from China, which is currently experiencing deep financial troubles in its housing sector. The housing sector is an important driver of economic growth in China, and China is a key driver of demand for commodities globally. Industrials include a large variety of companies with different business models, but has a lot of companies that have a larger exposure to the financial health of the consumer or the operating environment in South Africa, with notable exceptions being large rand hedges like Richmond and British American Tobacco as an example. Financials, and in particular the banks, are a unique type of company, quite distinct from your typical industrial company or mining enterprise. So while a retailer might buy goods from a supplier at a low price and sell to a consumer at a higher price, the core business of the bank, you can call it buying and selling money, an activity that's called maturity transformation. This buying of money by banks is in the form of borrowing money, predominantly via deposits at lower interest rates with relatively short terms. The banks then lend this money at higher interest rates, but also at longer terms. The difference between the lower borrowing and higher lending rate, which is similar to a retailer's gross profit margin, is called the net interest margin. And it is the main source of profits for the bank's traditional activities. Given this business models, the banks benefited from higher interest rates because the net interest margin widens during a rate hiking cycle, something referred to as the endowment effect. The lending rates reset higher and more frequently when compared to the borrowing rate. This is the main reason financials have outperformed the market during this rate hiking cycle. It should be noted, however, that there is a balancing act. Beyond a certain point in the hiking cycle, the positive impact of this endowment effect begins to dissipate. At a certain point, higher interest rates begin to compromise the client's ability to make loan repayments to the banks, and you also start to see a reduced demand for new loans. This dampens the profit prospects for banks. This graph shows the total return index for each of the 4 banks, rebased to 100 at the beginning of the interest rate cycle in South Africa. The gray shaded graph shows the total return index for the all-share index during the same period, while the solid blue line shows the average for the big 4 banks. The big 4 banks have outperformed the market by a significant margin during this hiking cycle. Differences in the performance of the banks reflect different exposures. Standard Bank, for an example, has a large footprint in the rest of Africa, while Nedbank has a dominant South African client base. FirstRand is more geographically diversified with business in the UK. The banks also have diversified business models to generate non-interest revenue by having an investment banking segment, as an example, or insurance operations. Despite the different exposures, they've all outperformed the market, showing that even during a rate hiking cycle, the equity market still provides select opportunities for generating strong real returns. We've taken a look at how the JSE has performed since the start of the interest rate hikes, but what can we expect going forward? We are nearing the top of the rate hiking cycle if we haven't reached it already, with the key question being how long we will remain at the terminal rate before we see the first rate cuts. As shown earlier, when the policy rate is lowered, then equity real returns are expected to lift from prevailing levels. Further, current valuations are also expected to serve as a tailwind for equity real returns going forward. This graph shows the current valuation of the JSE relative to its own history and relative to emerging market peers. The JSE All's evaluations, as measured by the price to earnings ratio or the PE ratio, is substantially lower than the historical average. Shares are trading cheaply on the JSE, or put differently, current share prices are pricing in a bleak growth prospects for companies going forward. The AllZ is also trading cheaply relative to emerging markets, showing that South African shares have not rebounded to the same extent as emerging market peers after the COVID rebound. And emerging markets as a whole are trading below developed market peers. The downside risk in the near term is the potential of a USA recession, maybe a soft landing, perhaps an even harder landing. The upside, however, given the context of this graph, going forward, we expect South African shares to have a more conducive environment to deliver higher real returns, given that financial conditions and valuations are expected to blow a tailwind behind their sails. And that concludes my presentation. Thank you for listening.
Thanks, Stanley. Really informative stuff. Mike Atsatz will now summarize and close the webinar. Just a reminder to please make sure you watch the full session and add your ID number to the CPD section. You can watch this event on this platform at any time until the end of November and still be eligible for your CPD points. The CPD certificate will be mailed to you during December 2023. Thank you for joining us today. You have the floor, Mike.
Thank you for joining us in this last edition of A Moment with our investment gurus for 2023. In this session, we did a deep dive into inflation and interest rates. Sanisha started the session talking about inflation, the risks in inflation, and the potential inflation and interest rates trajectory. I had a fascinating conversation with Robert Sgraver from Crown Agents. We gave us a developed market view of interest rates and inflation and some of the exogenous shocks that he's seen in the investment universe. Zazanda followed up talking about cash and the good opportunities that we're seeing in cash investments at the moment with the high yields available in cash. But not to forget about the longer duration as interest rates start rolling over, as inflation has rolled over. The longer duration fixed interest investments are much more investable and give good opportunities out into the future. So they should be remembered. And always within a portfolio management construct, we need to think about balancing our risks. Stanley spoke about the good opportunities in equity investments at the moment, and a portfolio always needs to think about both the current opportunity sets, but also have a forward-looking perspective in terms of what opportunities are there and are going to unfold into the future. So this being our last edition of the Investment Gurus for the year, I hope you have a good festive season and travel safely. It's been a long, hard year for all of us, and we all need some rest. I look forward to seeing you in the new year.